Welcome to this edition of Fitch Virtual Investor Series. I'm Hélène Heberlein, based in Paris and responsible for Fitch Cover Bond ratings. I'm joined today by my colleagues Côme de Montpellier, who heads up our London Cover Bond team, and Susan Hosterman in our New York office in charge of Canadian cover bonds. Our market has witnessed very strong issuance in the first half of 2022, the most active in fact in the last 10 years. The volume of benchmark-sized cover bonds is reaching 146 billion of euros so far this year, and Canada is at the top of the list with around 29 billion euro equivalent. So Susan, let me ask you what the reasons are and whether you expect this trend to continue in the second half of the year.
Sure. So the main reason that covered bond issuance in Canada has been so high this year is the fact that the Canadian issuers are replacing the covered bonds that are maturing, both the Canadian dollar denominated bonds that were issued in 2020 to provide liquidity to the banks during the COVID pandemic, as well as their normal issuances. There were a large amount of issuances that are maturing this year, and they are replacing them. They do this opportunistically when rates are low and it makes sense. And there's been high demand recently for Canadian covered bonds, just because the sovereign is highly rated at AA+. All the banks are investment grade, and the covered bonds majority hold AAA ratings, and there's one issuer that's rated AA. All are on outlook stable, and all have several notches of uplift before they would be downgraded when the issuer would be downgraded. So there is a flight to quality that we're seeing from investors who are looking for a safe haven in this turbulent time. I do feel that issuance is going to continue. This year, we already exceeded last year's volume, and I feel we are on track to exceed 2020 volume as well.
Right. And Canada is also a hotspot because it has experienced one of the largest increases in house prices since the pandemic began. And in other countries too, home prices have kept rising throughout the pandemic and are threatened by interest rate rises, among others. Côme, what can you tell us about the UK and the Netherlands?
Yes, indeed. The UK and the Netherlands are two countries where house prices increased significantly. Since 2019, it was plus 24% in the UK and 40% in the Netherlands. And the home prices in these countries are expected to decrease, to increase less than they used to, especially because interest rates are increasing. We do expect asset quality deterioration in those countries, especially for first-time buyers, for borrowers with low income and high loan-to-income ratio. However, for our cover pools, we expect that this quality deterioration should be limited. And there are two main reasons for this. First of all, if you compare to the period leading up to the global financial crisis, we can see that the household debt has not increased by as much as it was at the time. Actually, it was fairly stable, household debt in the UK and in the Netherlands. The second reason is loan-to-value ratios are quite low, and especially because house prices have increased so much in 2020, 2021. In those countries, the index loan-to-value ratio for our cover pools is significantly below the non-index one. And actually, it would take more than a reversal of house prices of the 2020, 2021 for the index LTV to give back to the non-index LTV ratio. So we have a significant cushion in most cover pools.
And if we broaden the view further, which programs are more vulnerable to a worsening macro environment?
So to look at programs which are more vulnerable on the asset side, first we look at countries where the house prices have increased the most, and especially, as you can see on the graph, countries like the Czech Republic, but also Australia, the Netherlands, New Zealand are countries which have seen a very high house price increases. So we expect a correction in those countries that could affect the performance. But secondly, what's most important also is just to look at whatever's been originated recently at the peak of the market. So seasoning is an important factor to look at. And we can see that the seasoning in most countries is actually quite high, especially in Southern Europe. It's interesting because Southern Europe is a country where we have a lot of floating rate mortgages, so they would be directly at risk from the higher interest rates. But the cover pools in these countries are very highly seasoned. And that's in contrary in Eastern Europe, for instance, where the cover pool are not as highly seasoned and where a lot of loans have been originated at the peak of the market. So they would be more at risk.
And let's finally move to a regulatory topic, the harmonization of cover bond regimes. With the European Cover Bond Directive now in place, our attention is turning to programs issued outside of the European Union and which do not benefit from the same favorable risk or regulatory treatment. If we look at the largest countries, Australia, Canada, and the UK, is anything material missing for regulated cover bonds to be recognized as equivalent?
So the quick answer is there's not much missing effectively for them to be recognized. And we just published a feature on this saying they're well placed for EU recognition. And especially if you focus on four key items of the EU Cover Bonds Directive, they're already aligned effectively in terms of the liquidity rule, the 180-day liquidity rule first. They do have more liquidity protection in Canada, Australia, the UK than 180 days. In terms of the extension feature being non-discretionary, this is the case for all the programs in these countries because they use an SPV template and only the SPV rather than the issuer can exercise the extension provision. In terms of over-collateralization, there's a minimum over-collateralization in legislation, but also issues commits to a higher minimum over-collateralization, and that should be enough to get favorable capital treatment for EU banks investing in them. And also in terms of swaps, they do follow the requirements in the directive. There are a lot of swaps in these programs because they do issue a lot in foreign currencies, in euro or in US dollars, and the swaps cannot terminate upon the defaulting, and also they're only there for hedging purposes. So it's in line with the EU directive requirement.
Thank you for your insight, Com and Susan, and thank you for joining us. For more information on global cover bonds, please visit fitchratings.com. And if you do have any questions on the topics we discussed, please send an email to the address on the screen.